Hello, Ira Coiner here, President and founder of Triathlon Partners. Thank you very much for tuning into this episode of Triathlon Partners TV, and we will be discussing tax efficient investing. Now, this is always a very important topic because we want to keep as much of your money in your pocket and minimize the amount of taxes that you are paying. Now, to us, what a tax efficient investment is number one, it earns money tax deferred. So you're not paying taxes every year. When the money is earned, you get an interest payment or capital gains. It's not taxed. That's deferred. That's deferred. The taxes are deferred on the earnings. And number two, we want an investment that when you withdraw your funds, there are no taxes. Right? No taxes, it's tax exempt, or the product it's in does not get taxed, right? So these are things that people are kind of familiar with, like a 401k, the interest is tax deferred, right? You have it through your workplace and you don't pay taxes on it until you withdraw it and you retire. So it doesn't fit our second parameter that we like. The other hand, you have something like a Roth IRA, and that does fit both criteria. And because when you take money out of it, it's not taxed at the end. However, there are limits to a Roth about the amount of money that you can put in, as well as limits on who can contribute. You have to earn less than a certain amount of money every year. So, and if you want to transfer money into a Roth, you have to pay taxes on it immediately. So you can take your rollover 401k and pay all the taxes now, move it into a Roth. But again, we want to minimize the amount of taxes that we pay either upfront during the investment period or at the end. So something that we think is a very good investment that fits this criteria and has other multifaceted objectives is life insurance. Now, there's several types of life insurance. There's term insurance, which is great for certain things. It has a tremendous amount of insurance you can buy for the premium you pay. However, term insurance only lasts a certain number of years. So after it expires, you have to buy a new policy. And generally, you'll 100% chance you'll be older when it expires, as well as most people don't get into a better health class. So you're just going to be paying a lot more for it. So it is good to have some of your insurance in a permanent life insurance policy. Now, there are two types of permanent life insurance. One is whole, another is called universal life. Now, as long as these policies are worth something, have some cash value, they will have a death benefit, which is great because the death benefit could last, hopefully, until your 70s, 80s, 90s. But something else that these permanent policies do is they accrue cash value. So if you look at your premiums and you don't look at it as just a bill for the death benefit, you look at it as an investment in yourself for your retirement, that investment portion grows tax deferred. Right? And then many people use life insurance like a pension. So when they retire, they take the money out and that money is withdrawn tax exempt. So it fits both the criteria that we're talking about. Right? So the secret of creating a policy that can maximize your growth in life insurance is the universal life. And there's several reasons why. Right? Universal life is very, very flexible, much more flexible than term. And what we like to do, because we like to mix it with that term insurance, which gets the maximum amount of death benefit for the least amount of premium, we like to have the opposite on the universal life, which you would think, this doesn't make sense. I'm paying a ton of money in premiums. I'm getting very little protection from the death benefit, right? Well, when you do that originally, yes, the death benefit's not going to grow over time, which is great. But when you put your money in these permanent life insurance policies, some money is going to buy the death benefit. So the rest is going to buy investments. And those investments are going to grow, and they're going to grow tax deferred. You're not paying taxes every year on the money it makes. And then when you withdraw the money, the way to withdraw money from life insurance is tax exempt, right? So you could see why we want to put most of the money that we invest in these policies, we want to put in the investment part, not in the death benefit part, because we want that benefit later on in life where we can see that tax deferred growth and take that money out tax exempt. So it's very important that you have someone who can structure this properly, because you don't want to have a ton of death benefit in these policies. You want to have that growth. So the proper way is to blend them. Now, there's two types of permanent life insurance. There's whole and there's universal life. Number one, I think whole life policies tend to have higher fees, significant higher fees on some policies, right? Higher fees means less money in your pocket. So that's one thing we don't like. And number two, the investment options. Very nice, very steady investment returns from the whole life carriers, but they're based on the whole life carriers' performance. And there's nothing wrong with that, right? But the universal life, they have what they called indexed investments. And the way that they work is there's a floor and a cap every year on how these investments can perform, right? So the volatility of these performances over time is very small. It's about 60% of what the actual stock market's volatility is, because you can't lose money on those investments, right? But there's a cap that it can't earn more than a certain amount, which kind of makes sense. How do they give me that great floor? You know, they have to cap it, and that cap could be 8, 9, 10, 11, 12%, depends upon the market. It also depends upon the policy, and it also depends upon what state you live in, right? So majority of people, they're going to get something with very, very favorable returns, right? So when you take those higher returns that you can earn in universal life and then the lower fees, you're getting something that's much more superior than the whole life. In fact, if you have a whole life policy, we could try to transfer it without any tax implications into a universal life policy. And you can actually compare what one looks like versus the other, and it's fantastic. Now, something else that we can do is we take what I would invest in the universal life policy and then invest in the same asset if I was buying the stock market, right? Or investing my own money, but in the same investment with the same return. And when you look at these things compounded over time, and then taxes need to be taken out, the universal life policy always does significantly better between the cash value that can be removed because it's not paying taxes and the residual death benefit of the policy after the money is withdrawn that is also paid tax-free. So this is very important because people often think of life insurance. They don't want to touch it. It's very expensive. But if you're a saver, you have to consider saving in a life insurance policy because tax rates, let's just prepare for the worst, and that means they're going up. If they're going up, you want to make sure you're earning as much money as you can in vehicles that don't pay taxes, and when you withdraw them, it's not paying taxes either. All right, well, thank you very much for tuning in. I hope this was a good foundation on tax-efficient investing and insurance. Please, we like our stuff here, so subscribers, thumbs up, right? Followers and friends, please press those buttons on social media. We really appreciate it. And, you know, once again, we believe in educating, engaging, and empowering our clients. So we hope this video hit the spot for you. And have yourself a blessed day. We're just going to tune into the disclaimers, everyone's favorite part of the show. And there we go, share.